All right. I should play music or something. If I knew how to do that. Okay. Hey, Jose. Good morning. Nick, you want to come on the stream? Give us your perspective on what's happening. Thank you, Jose. That's very nice of you. I'm hoping to help Proppy and sort of the blockchain and real estate space. I think there's some real traction there. I mean, we're probably 5 to 10 years out on that, but there's some areas where I think that technology is going to be super useful. All right. I think I'm caffeinated. Mountain bike ride. Nice. Well, just let me know. I mean, anybody who wants to hop on, like I said, this isn't some special interview of, experts or anything. It's just I'm going to present what I've talked about to some other folks and do it that. All right. I'm going to be right back, close the door, get going. All right. It's 9 a.m. Let's get started. If anybody joins in, they join in. If not, I just ramble on for a few minutes and then we call it. If you have any questions, have any comments, just put in the comments or let me know if you want to, hop on and sort of share your perspective on what's happening. So the impetus, I think, for this was, I did that podcast with Nick Bailey over Remax. It was a great podcast. I rather really enjoyed it. But, I think he want to talk about iBuyers and sort of institutional money in real estate. My opinion on iBuyers is fairly well known. Plus, we had Tyler Hickson from Open Door there. So, we got the expert there. I don't need to get into that. But I do think there's something to be discussed, I think, on what's happening in the housing market. It really doesn't get talked about very much. Which is the impact of institutional money. Now, so I want to present kind of just some data, some stuff that I've most recently talked to the Oklahoma Association of Realtors about. But I'll, I'm thinking is maybe I'll just kind of go through those slides in the presentation and then kind of point out, some of the things from there. So unfortunately, I don't know how to share a full screen presentation, so we'll just have to look at the slides together. All right. So there we go. So this presentation, I've called it kind of the end of home ownership with a question mark, because really, when you look at what's happening, the combination of the variety of factors, I think this is sort of what we're looking at right now. So this is the point thing. I think the thing that was really important for me to point out, to the attendees, or I want to point out to everybody here, is, obviously the whole pandemic and 2020, 2021, everyone's talking about how hard it is to be a buyer. Everyone's talking about how competition is really ramping up. The point I would make about that, though, is this isn't new, right? This isn't something that happened because of COVID or because of work from home, because of anything like that. Because this is a story in the New York Times in 2019, June of 2019. And the headline, as you can see, is, "Do you want a house like this? Prepare for a bidding war with investors." Right? So this is a trend that's been ongoing. And obviously, like every other trend, COVID just kind of accelerated the trend forward for all of that. Because here's the story from April of 2021, very similar. Orange County Register, first-time home buyers getting outbid by big companies. Buyers find it hard to compete with investors. We all know this, right? I mean, I assume most people that are watching this or tuning in are real estate agents. You all know this. You see this in your more local markets. God knows the number of agents and brokers I've talked to said, like, if you are FHA or VA, like, forget it. The chance of you getting that house is pretty small, right? Pretty small. The things I want to present, though, were, and again, a lot of folks know that this is happening, but I don't know how many people are really thinking about and paying attention to it, which is a phenomenon known as build to rent is really kind of on the rise, right? It's one of the biggest trends happening in new home builders. And the reason for it, so build to rent is basically new construction where you go in and you build houses, not for the purpose of selling it to people, for the purpose of selling it to families, for the purpose of renting it out, right? And the best example of this I found was this quote from The Real Deal: "Investors increasingly compete with first-time home buyers for homes." This was published in April of this year. And here's what it says. For an extreme example, look to Conroe, Texas, where D.R. Horton recently built 124 rental homes. But really, they built 124 homes, right? Then they rented those homes out, subsequently put up the entire subdivision up for sale. And they sold the entire subdivision for $32 million. The thing that I think we need to think about and pay attention to was the fact that that's twice as much as what D.R. Horton typically makes, meaning D.R. Horton, doubled its profits or doubled its revenues, right? By selling these 124 homes to some institutional fund, as opposed to trying to sell them individually to families, right? So this is built to rent. This is really kind of taking off, right? But one of the interesting things about it, so I went to a property management conference recently, and listening to sort of those people who are much more involved in the investment side of things, what they point out is that cap rates are really falling, right? So here's what that means. Obviously, it's not like investors are some new phenomenon in real estate, right? Investors have been around forever, but the typical sort of traditional real estate investor is someone who says, okay, I'm going to buy this house, or I'm going to buy this unit, and I'm going to rent it out, and I need the unit to actually generate a profit. It has to generate cash flow. I have to pay for expenses. I have to do maintenance. I have to do all these things, pay for property management. And there comes a point where the price doesn't make sense, right? So investors, it doesn't pencil, right? It just doesn't, I can't pay more than $350 for that house. So therefore, right? They're not going to buy it. Now, Jose, I'm going to answer that question. I think let's discuss that. But the point I think I want to make here is cap rates are compressing. The price of the homes are so high that the traditional investor, it just doesn't make sense for them to buy those houses. And yet we're seeing all those houses go off, flying off the shelf. What is going on? So my theory, right? Because of this, I'm saying the numbers don't make sense. So my theory, and this is just a theory because there's not a whole lot of data support. There's some support, but not a whole lot. My theory is that it's not the traditional real estate investors that are driving this. I think it's a new type of investor. It's a new breed. So here's the backup for that proposition. Okay. So this is a report from who I think one of the best companies that are doing research in the sort of investor residential real estate investment space. And it's John Burns Real Estate Consulting. They put out a report in April, again, talking about institutional investors, stiff competition. But in that report, here's what they said. More and more of these investors are institutions like hedge funds, sovereign wealth funds, and insurance companies chasing profits. Right? So they're the non-traditional. These aren't like traditional real estate investors, not traditional REITs. These are new type of institutional money that has come into our space. And as an example, again, this is from their report. Go subscribe. They do some really good work. And they tracked sort of from 2020 to April when they published this, how much money sort of flowed in, came into residential real estate from this. And their take is 9.26 billion in equity. And obviously, if you know anything about kind of the way these things work, you would lever the equity up, right? And get loans based on the equity that you have. So your buying power might be 10 times this, 5 times this, whatever it is, right? So we might be looking at 90 billion in buying power coming from this investment from 2020, right, up till April of 2021. That's a lot of money, right? That is a lot of money. Now, so this is again from their report. Some of the things that they cite said investors purchased 20% of all homes sold, resale and new. The thing I found interesting is that according to them, investors now account for a higher percentage of home sales than during the height of the bubble, right? And at least in a bunch of markets, right? A bunch of really desirable markets like Houston, Riverside, San Bernardino, Los Angeles, Orange County, San Francisco, Seattle, Nashville, and San Jose. Which means in those markets, if you are a family buyer, you're just, it's going to be real rough times for you. If you want to sell, yeah, it's fantastic. Total seller's market, I suppose, in that sense. But if you want to buy, like you're going to have some real problems. Right? Now, here's kind of what they think is causing this, right? Capital availability, it could surge and then shut off, etc. And there's some reports out there that suggesting maybe things are tamping down. There's more supply coming on, demand is falling off, etc. The housing market should ease up. Maybe because these are the reasons that John Burns listed, right? COVID pushing institutional investors, safe haven, investment diversification, hedging against stimulus inflation risk, which I highlighted because I think that's the most important. We'll get into that. Yield chasing, democratization of rental investing, tax incentives, less stringent regulatory hurdles. All of those are true. I mean, I have no doubt all of those are true. To me, when I looked at this list and I think about, okay, these guys that are coming in, I think that hedging against COVID stimulus inflation risk is probably the most important aspect of it. Why? Well, this is a chart that I've published, on the blog, time and again. And I've said this is probably the most important chart for us to understand. So this is the United States money supply, M1 money stock, right? And some people have talked about this, especially like the gold bugs and some of the crypto guys have talked about this. But according to, I know it's a little hard to see, but if you look at, kind of what's happening here. So we have, this is total US money supply, steadily growing. And then 2009, guess what happened then, right? The first bubble started increasing the money supply and then bang, all of a sudden, this vertical line in 2020. So there are a bunch of like mainstream reports. There's a bunch of analysts, there's economists who talk about how they think we've printed something like 35% of all US dollars in existence since 2020. Like just think about that. Just try and wrap your mind around that. 35% of all dollars in existence were created since the start of 2020, right? Now, the government says that inflation, there's some inflation pressure, but it's temporary. And the nominal rate is something like 5%. Right? And the question is, do you believe it? Do you believe that the real inflation rate is 5%? So this is some data I found. The red is kind of the government stats, and the blue is shadow stats. So what's shadow stats? Shadow stats is a website, their company. And one of the things that they do is they look at inflation if we were using the same way that we were measuring inflation back in 1980. Because, the government has changed the way that they measure inflation a couple of times, right? So if they said, okay, if we use the same exact methodology that we were using in 1980 and we measured inflation, what would it be? And their conclusion is something like 13.5%. Right? Now, why do I bring this up? I bring this up because I think this might be what's happening, right? It's not that the housing market is hot. It's not that the home prices have gone up. I'm saying home prices have not gone up. Instead, I think what's happened is the dollar's been devalued. Because if that's true, what we have is not like a hot seller's market. It's not a housing market super hot, and as an investor, I should jump in. What we have is a new normal, right? This is permanent as long as we continue to sort of, sort of monetize the debt and keep printing money. Now, here's the thing about those big institutional investors, right? A lot of them, I know a lot of them, right? And they call me because, they want to talk about, what's happening with real estate. I do these expert calls, all these things. And so you got to think about like who these people are. They are, if you will, the smartest investment professionals in the world, right? I mean, they work for huge hedge funds managing billions and billions of dollars. These are, like I said, I mean, they make millions of dollars a year, right? Being compensated because they're so good at what they do. They're amazing. They're total professionals, right? They all have a hurdle rate. The hurdle rate meaning they have to at least beat the S&P 500, right? So they go on and do all these exotic strategies, and they invest, huge amounts of money and equities and all of that. But every single hedge fund that I know of, private equity funds, hedge funds, institutional, insurance companies, a lot of them have reserve requirements, right? Meaning you can't just take your entire $9 billion and put it into stock market because it's too much risk. You have to diversify. Well, they've been holding a lot of that cash in stock, in bonds and in cash, right? Because obviously you're going to play in the stock market, you're going to play in commodities. You need to have some amount held back, right, to hedge that risk. And you would have it in cash, you would have it in treasury bonds, you would have it in bonds. Okay, then you got to think about the fact that in the investment world, at least for the last 2 years, maybe 3 years, as long as I've been looking at it, guys like Ray Dalio have been saying things like cash is trash. And if you're in bonds, you're an idiot. Why? Because bonds are paying maybe 2%, 2.5%, and inflation's 5%. And that's, again, the nominal inflation. Then you're literally losing money, right? You're literally losing purchasing power if you're holding bonds. All right. So the best investment professionals in the world look at this, look at the 35% increase in money supply, and they go, yeah, inflation's not 5%, it's 13%. We need to park our cash somewhere that's going to at least outperform inflation. Where are you going to put it, right? Where are you going to put it, right? And the interesting thing there is, if you think about it, if you got to put $50,000 somewhere, there's a bunch of different things you can do. If you got to put $500 million somewhere, there just aren't that many places where you could park that kind of cash. And one of the places, and one of the safest, is residential real estate, right? I mean, certainly you're not going to put in commercial real estate after COVID, right? I mean, who the hell wants to own office buildings right now? Who wants to own retail space? You want to own houses. So I think this is my theory. It's just a theory. There's not a whole lot of backup, primarily because we don't collect a lot of information on buyers, like who they are, and it's not like BlackRock or T. Rowe Price is going out there and purchasing houses at BlackRock and T. Rowe Price, right? They're setting up all these little LLCs. You don't really know who the beneficial owners are. So it's really hard to track exactly what's happening. But that's my theory. My theory is that due to inflation, due to these guys needing to park their cash somewhere, they're putting into real estate. Why that's relevant for our discussion is because if you think about it in those terms, this cap rate thing really doesn't matter, right? In other words, the traditional real estate investor needs to care about rent. They need to care about property management costs. They need to care about all that because they're going to, buy an asset and they need it to generate rental income, and it needs to pencil for it to make sense. On the other hand, if I'm a big hedge fund and all I need to do is park $1 billion somewhere where it's not going to erode and lose value because of inflation, I might as well just buy real estate. Whether I rent it or not, it doesn't matter to me. Why? Because as we all know, rental housing is appreciating something like 15% a year, more in other areas. So if I need to park my money somewhere, then that makes perfect sense. And doesn't matter to me what I'm paying. Cap rate doesn't matter. What matters is that I buy it and I park my money. And then 3 years from now, 5 years from now, when something else comes up, maybe I decide I want to start putting huge amounts of money into Bitcoin. I'll sell the real estate. I won't have lost any spending power. And then I'm able to do that. I think that's what's happening. So that's my theory on kind of the impact of institutional money, right? Now, I think I titled this stream Institutional Money and Generation Screwed, because there's another aspect of this, right? That's kind of all coming together. And there's so many different aspects coming together, but I'll just cover this and then we'll just kind of have a conversation about it. Because in the real estate industry side, right? That's a really good point, David. That's pretty low, but that's a REIT, right? I mean, if I'm a big $35 billion hedge fund, I don't know that I want to own Invitation Homes stock. That's still a stock market. I want to own the underlying assets, which are appreciating 15%. So, anyway, so we have, on the one hand, we have all this institutional money, and maybe it's because of inflation, maybe because of other reasons. And the industry side, what we're saying is stuff like, well, yeah, the market's a little crazy, but hey, millennials are coming of age, they're gonna, etc. And here's the proof of that. So this is Realtor.com did a 2021 study talking about, sellers will get top dollar, home price will hit new heights, home sales are going up, all sort of quote positive signs. And then there's this little part in the corner. I know it's a little hard to read, so I pulled a quote out. And this is what they say. No longer just dominating the entry-level market, millennials are now taking over as quote move-up buyers as they have children and need more space. I read that and I'm like, really? Because I've been tracking millennials for a while. I wrote a whole 100-page report on millennials and millennials in real estate. But let's just point out the obvious, right? They say move up buyers as they have children and need more space. And my thing is, what children? Because they're not having any. So this is 2020, right? US birth rate drops to an all-time low of 1.73, right? Millennials are not having babies, y'all. They're not having kids. And in fact, it's so obvious now, it's become so evident that this is a report that came out from one of the best sort of investment analysts of the residential real estate space, a company called Zelman and Associates. And they released a report called Cradle to Grave. Let's face it, we have a people problem, right? It's literally like stuff I've been, I think, obsessing about since like 2010. Like, I'm like, they're not dating, they're not getting married. Something's going on with millennials. But basically what their point is we just don't have population growth, right? So it's a little hard to read, so I'll read this. Population growth, the crucial underpinning of incremental housing demand, is on a troubling trajectory. Which is a fancy way of saying young people ain't having no babies, and since they're not having no babies, they ain't buying houses. It is what it is. In fact, millennials and Gen Z, they're not just not having babies, they're not getting married, right? So this is Pew Research talking about 1 in 4 of today's young adults may never marry, right? They're not even getting married. Why do we care as realtors? Why do we care as real estate people? Because of this. It's not Johnny Appleseed. This is actually Urban Institute study. What they said is delayed marriage had the most significant impact on millennial home ownership. Being married increases probably owning a home 18 percentage points. And that's after you account for all these other factors, right? Age, income, race, etc. So simply being married makes you like 18% more likely to own a home. If you're not married, you don't have babies. Guess what housing demand does, right? And like I mentioned, this is, the whole thing I wrote, but this is sort of my overall general conclusion about millennials and probably as Zoomers as well, which that they're the most divided generation we've ever seen, right? Where the elite, call it the top 15% or so, they're more elite than ever. They're really well educated. They're super smart. They make enormous amounts of money. They're doing great. The non-elites, the bottom, say 85%, they're more screwed than ever. They just have, a lot of them have college degrees, but they don't have jobs that require them. So they're overeducated, they're underemployed, humongous student loans. Wage growth is stagnant. It basically hasn't happened in 10, maybe 20 years, but everything's more expensive and housing's going up 15, 20% a year. That's the reality of what's happening with that generation. So, this last point, I'm like, the fastest growing party among the youth is the Social Democrats, the socialists, right? And they embrace it. They love AOC. And I'm like, I don't blame them. I actually think it's a wonder more are not socialists. I mean, I would be, right? If I were 24 years old today or 29 and I have some whatever, English degree from some school and $100,000 in loans, and I'm living back at home with mama, and I have zero prospects of ever owning a home. I can't get married because I don't have any money. I'm not going to have any children. Like, why not be socialist? I mean, it just makes sense to me. So I brought this up, especially among that, because I was presenting especially to a realtor association. The point I would make there was, yeah, we talk about homeownership matters. Unless you can't even dream of owning a home, then it doesn't matter one bit. But on our side, because real estate industry, you tend to deal with buyers and sellers. The folks you're dealing with, the millennials you're dealing with, are these elites, or they have generational wealth, meaning parents are helping them buy houses. The parents are the ones who are helping with down payment. You're really not interacting that much with sort of the non-elite millennials and non-elite young people. So you're not seeing some of this dynamic, whereas the property managers are. And like I said, I sort of talked about this at property management conference, and they're all like, "You're right. This is literally what's happening." So that's the presentation. Let's see. Stop sharing. So that's kind of where we're at. I mean, so when we talk about impact of institutional money, I think there's a slight misunderstanding, if you will, of what it is. I feel like too many people think this is just a temporary blip, that it's just because of work from home and all these people from California move into Texas or New Yorkers move to Florida. I don't think that's what it is. I really don't. Right? I really think what's happening is this institutional money, that needs to park their money somewhere because they're just afraid of 15% inflation. So they need to park in an asset that's going to appreciate at least by that much, right? They're not even looking to make returns. They just want to preserve their capital. And I don't know how you compete, right? The thing that I think real estate agents and brokers need to think about is this, right? Let's say 20% of all home purchases right now, and that's John Burns' estimate, are being bought by investors, right? Yeah, we don't know if those investors are your mom and pop investors that you're used to. We don't know if they're BlackRock, right? We just don't know. But given, $9.26 billion, of equity money coming in, we know for a fact that a lot of these institutional funds are really allocating a lot of capital into buying, housing. At some point, all the sellers, a fifth of the sellers are going to be those guys, right? A fifth of the buyers are these big institutions, and a fifth of the sellers in a few years are going to be large institutions. And the question I think you got to ask is, would a large institution hire you? Right? So this is in line with a whole bunch of other trends I talk about. Is my sense is that residential real estate is becoming more and more like commercial real estate. And I came out of commercial, and I could tell you, big institutions do not deal with mom and pop shops. They don't. They deal with CBRE, they deal with JLL, they deal with Cushman & Wakefield, right? Because they're big companies. They want to deal with other big companies. And you could talk where, local is what matters. So you could talk all that as much as you want. The fact of the matter is, BlackRock's not going to want to have 3,000 agents that they're working with. They would really much rather have one company that they're working with who can then provide them 3,000 agents. That's something that we don't talk about. That's something we don't think about. But I think it's going to happen. At the same time, millennials, Gen Z, they're utterly screwed. There's been very little being done to kind of help them become homeowners. There's a whole lot of efforts, rent control, eviction moratorium, all this stuff to keep them as renters, but there's not a whole lot. I don't see a whole lot of effort. I don't see a whole lot of programs out there saying we need to somehow enable these people to become homeowners. So I assume that sort of political pressure is going to grow over the next 3 years, 4 years, right? I mean, certainly I think before the next presidential election, this is going to be a major political issue. And I don't know that that we as an industry are even ready to kind of deal with that. And this is something that's been going on for, I don't know, 5-10 years, right? So this isn't like some new, oh my God, I had no idea this was happening. We all knew this was happening, but that's what's happening. So let's try and deal with some of the comments and questions. Institutional investors are affected less by rent control, eviction moratorium, step to tax basis issues, thus further acceleration of the market share. Yeah, Nick, I think that's right. In other words, if I don't care about rent, if I only care about, or stepped up basis, who cares? All I'm trying to do is preserve some of the spending, some of the purchasing power of the capital, right? And if I'm one of these funds, I'm not making money from real estate. That's not what's happening. I'm making money from betting on Tesla or buying gold mines in Indonesia. But I need some amount of money held in real stable assets that has low risk. Well, then yeah, I think residential real estate in the United States probably makes a ton of sense, right? Which then says to me, until something changes, in other words, until we hear some announcement from the Fed or from the federal government that we are, we're really going to stop demonetizing the debt. We're going to stop printing money, basically. I think this continues. I don't know how we get around that, right? And, then I think now more and more people are becoming aware of what's happening. I honestly, in my personal sphere, I'm just talking to friends and people I know, nobody I know thinks that inflation is 5%. No one, right? Because they're seeing gas prices, food prices, just go shoot up. I mean, obviously builders already know, like price of wood, price of appliances, is crazy. And that's if you can find any, right? Yeah. And David Torres makes a point. Their cost of capital is substantially lower than most people. Thinks up 2%. They can still buy higher and still maintain arbitrage. That's exactly right. Because these guys, again, when you're a multi-billion-dollar hedge fund, you're not going down to your local bank and getting a mortgage. I mean, that's not what's happening, right? These guys are either doing cash or they're getting money directly from like the Fed windows. Yeah, and the arbitrage opportunity is pretty amazing as well. So yeah, no, I think so this is how I think about it, right? So until we see some change in the monetary policy, if we think this is permanent, then whatever happens to housing, it doesn't matter, right? I mean, these funds have to park their money somewhere until some new asset class comes out that's going to be more stable, less risk, and offer this type of appreciation. I think this is permanent. Right? And if it's permanent, that probably should impact how you think about, how you deal with it, right? It probably should impact how you think about that. All right. So like I said, kind of a, lunch of the side of doom type of concept. But I mean, I don't know. Do you agree? Do you disagree? I could be dead wrong. Like I said, I just look like an economist. I'm not an economist. The economists might have a very different perspective. They might have access to data that I don't have. They might actually know some things and be like, no, Rob, you're totally crazy. This is not what's happening. We don't need to worry about this. Maybe, maybe. But I am curious kind of what you're seeing in your local markets. Like I said, when I've talked to local brokers and agents that I know, they all talk about the exact same things. Like, yeah, I mean, if you're walking through the door with an FHA, be prepared to waive every single contingency. Otherwise, you just can't compete, right? At the same time, I do wonder if on the listing agent side, how many sellers are starting to say, you know what, I don't care how much money these institutions are offering me, I want to sell my house to a family. So I will take a loss in order to do that. I don't know how many people are doing that. And if as a listing agent, you can actually make that recommendation to your client to take less money in order to keep housing stock in the hands of families, right, who are actually going to live there. I just don't know the answer to that. All right. Let's see. What else is there to talk about? All right. Anyway, if you have any thoughts, I'd be happy to have that. Like I said, I was hoping other people could join in the stream and we could talk about all this. But I do like the some of the commentary. This is so I just want to address one last thing. Jose talked about it's an offset Ponzi scheme, building homes based on promise to rent. I don't really think that's what's happening. I think it's more like they're building homes on spec, knowing that they could rent it, right? Because people got to live somewhere, right? And if you can't buy a house, you got to rent. You know, I mean, being homeless is really not an alternative if you have any kind of job, right? Or if you, I mean, people have to live somewhere. So I think if I'm a home builder, it makes perfect rational sense to say, hey, you know what? Rather than trying to build all these houses and then have the model homes and all that jazz, let's just rent it. Let's just rent it out, and once it's fully rented, we're going to take that entire package, to some institution and sell it off to them. Right. Nick makes a point. His office touched about 60 million a month in home sales. Can't remember the last institutional buyer that was in on a deal. Look, I mean, maybe it's not happening in your neck of the woods. But I guess one question I do have is, how would you know, that they're institutional buyer or not? Right? How would you know? David makes a point. Rents are skyrocketing, up 50% over the past 3 years. Again, I don't know what market you're in, David. And I think what we're starting to see is that rent is really on the rise. This is something that Lawrence Yun mentioned, which said, again, the way that the government measures CPI is through something called owner equivalent rent or some crap. Instead of actually looking at rents. So what he pointed out is if you look at, say, CoStar data, if you look at apartments.com, if you look at actual rental data from the market, it's shooting way up, right? And because it has to. Albuquerque. Yeah, I mean, I don't know. It makes sense to me though, because presumably Albuquerque didn't add, tens of thousands of housing units, right? So again, if people have to live somewhere, you can't buy, then you have to rent. And when you're in that position, you're going to pay whatever the landlord demands. And as a landlord now, you have to really think about, I may not be able to evict these people, right? I don't like that. At some point, we got to talk about the eviction moratorium and the damage that it's done. But if I were a landlord, and I'm not, but if I were, I would think real hard about, do I even want to rent it at all? And if I'm going to rent it, I have to take that risk that I may not be able to kick you out, even though you're not paying rent. I'm going to charge you as much rent as I possibly can, because I got to cover the losses when the inevitable, whatever eviction moratorium comes down, right? So yeah, I think rents are going to go up until, again, there's some rent control, there's some political move to try and stop that. But home ownership, I I don't have any answers. I don't have any solutions. I just know that it would be bad, right? Yeah, Nick, I think that makes sense. Lack of entity buyers versus people, 7-figure entry points. Look, I mean, given your market, it may be that just a bunch of people, you are populated literally by the elites of the elites. Those people could just cash in some Google stock and probably buy for cash, so they could be much more competitive. That's entirely possible. But I guess I'm curious, in your market, like how many people are able to come in needing a mortgage contingency and being able to buy homes, right? And again, maybe it's also that the real high-end luxury properties are not where these institutions are focused on. They're focused on, kind of that sort of middle-class entry-level homes. Let's see, Robert Horton, we've had $2 billion institutional investor out of Atlanta, purchased 117 homes in the Columbia area in the past year, 37 in the last month, at an average price of 195 from 90K to 103.60, and they're paying within 2 to 3% of list price. Yeah. Yeah. Of course. Of course. You know. Yeah. So the thing is, like, I think about being the seller. I think about being the listing agent, right? Say I have a client that's, they're elderly, they're, whatever. They're moving into, managed care facilities. So they want to sell their family home that was worth 300 grand. And here comes some institution saying, we don't care about any consumer. We don't need inspection. We don't need anything. We'll write you a check and pay cash. It will pay you your list price plus 5%. Hell with it. I will pay 5% above asking. Are you going to recommend they turn that down so they could sell to some family on an FHA loan that may or may not get approved? Like, who's doing that, right? So, yeah, and David makes the point, a lot of moms and pops are selling off rental portfolios, including myself. I think that's right. And this is one of the big things on the property management side. They're losing a lot of their clients. They're losing a lot of doors because the smaller investors, like, eviction moratorium, this stuff, like, this is screwed. Like, nah, I'm out. Just give me the money. Of course, when they do that, the question I have for those investors, so I'll ask you, David, I mean, including yourself, because you're selling off your rental portfolio, what are you going to do with the money? Right? In other words, aren't you in the same position that the funds are? Where can you put that money where you could at least make the 15% inflation hurdle? Right. There aren't that many asset classes that are doing that right now, right? Some stocks, crypto, real estate, maybe art, maybe classic cars, yeah, it's like, Jose, I think that's driving a lot of the attention into crypto because of this reason. Rolling into industrial, so you'd have to put that money into some sort of an operating business that's able to generate more than that 15%, right? So yeah, I think everything is being driven by inflation, and it's something that don't talk about. So I'll say this, and then let's wrap this because we're almost 40 minutes already. It's a long time for me to be just, talking by myself. Next time you're at some event, at your association or at your company, and an economist presenting, I would ask them, really, because I asked Lawrence and he wouldn't give me a real straight answer. He's like, yeah, inflation is probably understated. I'm like, what do you think real inflation is? Right? Because again, if you go by shadow stats and you use the 1980 methodology, we're at 13.5% inflation nominal right now. Right. And in some categories, we know housing is appreciating more than that year over year in most markets. Across the country, I think we're at about 14. We'll see. And in some markets, we know that home prices are appreciating like 20+%. And again, even that to me is a little bit suspect because we might be only looking at the whole market instead of like segments. So it could be that in that sort of first-time home buyer, 200,000-ish range is appreciating more than that. Maybe the luxury properties are, who knows? They're doing better. Maybe they're doing worse. Who knows? Who knows what the answer is? I just know that we don't have a whole lot of really great data on it. But I'll ask economists that come and present like what they think is happening. And it's those two things, right? The first is inflation. The other one is really demographics. It's marriage rate and childbirth, because it's just not happening, and that's going to have a real impact on kind of what consumer demand looks like moving forward. All right, okay, let me call it there so everyone can get back to work. This will be up, obviously it's recorded. I think it'll be saved on YouTube at least, and maybe I'll share it again and see what people think. Thanks everybody for coming by. You have a good Friday. All right, bye now.